Hello, everyone. Today we will be comparing Activision and EA.
Activision was founded in 1979 in Sunnyvale, California by former Atari developers. Activision went public in 1993 and acquired Blizzard Entertainment in 2008. They now currently have a market cap of about $58.53 billion. And Activision Blizzard is currently located in Santa Monica, California, with their most popular games being Call of Duty, World of Warcraft, Hearthstone, Overwatch, and Candy Crush. And they are currently under the investigation by the Department of Fair Employment and Housing. As you can see from the ratio analysis on the gross profit margins and the net profit margins, you can see that they have been steadily increasing over the past few years. And that this, for the gross profit margin, this means that their sales have been steadily increasing over time, and they're able to cover their direct costs more faster. As for their net profit margins, they have also been at that 20% margin, which is really good for companies, especially Activision. And this lets investors know that the company's management is doing a good job right now with generating profits and keeping the shareholders happy. However, with the investigation going on, this will most likely cause a decrease for the upcoming year for the 2021. Next slide. As for Electronic Arts, they were founded in 1982 by Trip Hawkins in San Mateo, California. They went public in 1989 with a current market cap of $36.97 billion. They are not currently located in Redwood City, California, with their popular games being Madden, FIFA, Battlefield, Star Wars, and Apex Legends. As you can see, their gross profit margins and net profit margins are pretty close to Activision's, but there's a big kind of spike in 2020 with the net profit margins. And that's due to tax returns that they had, which is what caused such sharp increase, and then back to the decrease. But for the most part, EA has been consistent in their gross margins, keeping their sales high at a steady rate with an expected growth due to their new games coming out this next year. Okay.
In this slide, I will be going over a brief summary of EA's and Activision's current stock status. The first thing I'd like to point out is the market capitalization for each company. EA has a market capitalization of about 37 billion, while Activision has a market capitalization of 58.5 billion. Although EA has a higher value per stock, Activision has a much bigger market capitalization due to the fact that they have a lot more outstanding shares. Over recent weeks, both companies have suffered sudden steep decreases in stock value. Prior to this steep decline, year to date, EA actually had a 5% increase in stock value, while Activision had a 9% decrease. Activision has been on a downward trend since July due to legal issues that the company is currently facing. Another thing we noticed on the table on the left is that Activision has a much higher volume of trades being made than EA. This is probably happening because Activision has much more outstanding shares than EA. The current PE ratios for EA and Activision are 55.78 and 22.59 respectively. Activision has a slightly lowered ratio compared to the SP 500, while EA has a high PE ratio overall. Although the PE ratio is high for EA, it could be because EA has high value expectations. Finally, the earnings per share are 2.33 for EA and 3.33 for Activision.
So on this slide, I'll be talking about the liquidity ratios. So that'll be the current ratios and the quick ratio. So we already know that the current ratio is the current assets over the current liabilities, while the quick ratio is current assets minus the in the inventory over the current liabilities. So it's just a little bit more conservative than the current ratio. As you can see that Activision's current ratios does seem to be better and higher than Electronic Arts, and that means that they have more. They'll be able to generate cash flow faster than Electronic Arts. However, as an investor, it does look really bad because having too high of a quick ratio or current ratio means that you're not using your cash flow efficiently. So the ideal current ratio is around 2, and anything higher than 2 shows that they're not being productive with their cash flows. So as you see, Activision is well above 2, and it's at, for 2020, it is at 3.41. While if you look at Electronic Arts, they do stay within the 2.0 range. They're not too high above the amount that such as Activision. And for the ideal quick ratios, it's around 1. Activision is much higher than the generally accepted quick ratio. They're at 3, while if you look at Electronic Arts, they do stay within the 1.0 range. Electronic Arts also is growing fairly steady throughout the years. They stay within the range, which is the most important part as well. It's fair to assume that with EA's growth and their decrease actually and their current ratios and their quick ratio, it means that their current liabilities are growing. So that means that that is a sign for growth. And that's one thing that is concerning about for Activision. And like I did mention, although Activision seems like they have a better cash flow, or they'll be able to generate cash better and quicker, Electronic Arts is using their cash flows more efficiently, and that's why we should invest in them. That will be my slide.
Hello, I will be covering EA's and Activision's asset management ratios. The first thing that we notice is that Activision has a noticeably higher inventory turnover of 2.51, 3.20, and 3.47 over the past 2 years in comparison to EA's 1.04, 0.60, and 1.26. It's difficult to pinpoint the exact cause of EA's lower than expected inventory turnover, although it is likely, at least in part, caused by an underperformance of certain games launched within the past few years, such as 2019's Anthem and 2020's Madden NFL, likely also exacerbated by the 2020 COVID pandemic. This in turn reflects on both companies' days sales outstandings, with Activision having a DSO of 145.35, 114.12, and 105.14 in comparison to EA's 349.85, 610.02, and 290.90 over the past 3 years. However, EA does consistently maintain a higher total asset turnover of 0.42, 0.50, and 0.55 over Activision's 0.35, 0.33, and 0.42. This could be attributed to EA's continued use of microtransactions within their existing titles, as well as their subscription service, EA Play, while Activision's online user base has noticeably declined since 2017. So what this all means is that despite EA's weaknesses in the first 2 ratios, EA may actually be generating revenue more efficiently over Activision. And that is a brief summary of the their asset management ratios.
In this slide, I will be discussing a couple of debt management ratios, the debt ratio and the equity multiplier. First, looking at Activision, we can see that over the recent years, Activision has managed to lower its debt ratio. In 2018, its debt ratio was 1.06, and it is now currently sitting at 0.76. In 2020, long-term debt accounted for 15.6% of its total assets. Although Activision has lowered its debt ratio, its overall debt amount has actually increased by about 15%. In regards to the equity multiplier, Activision's multiplier has remained relatively constant. It is currently at 1.54. Moving on to EA now, we can see that they have actually increased their debt ratio from 0.56 in 2020 to 0.76 in 2021. This increase can be viewed as both a good thing and a bad thing. It's a good thing because it can be seen as an aggressive approach for potential growth and future investments. And it can be seen as a bad thing because they are increasing their overall debts. In its most recent year, EA's long-term debt accounted for 14.12% of its total assets. The total amount of long-term debt increased by almost 50% from 2020 to 2021. As for its equity multiplier, we don't see much change there either. It is currently sitting at 1.69.
On this slide, we will be talking about the EPS ratios. So first, we will be looking at Activision. Over the last few years, there's been an increase in the Activision's EPS ratio. So for them, that is a good news, since it means that investors paid more money for their shares, since they believe the company has higher profits relative to its share price. We can also see an increase in Activision's book value per share over the last few years when we're looking at the 2018 through 2020. Now we're going to be looking at the EA. We can see an overall decrease in their EPS ratio if we compare the time frame 2019 to 2021. However, on the other hand, we can see that in that same time frame, their book value per share increased, which is good news, since it means that equity available to common shareholders divided by the number of outstanding shares increased. That would be it for my slide.
We chose to compare EA and Did we not decide on who was doing the last slide for this one?
So we chose EA over Activision because the reason why we chose to compare both companies is because they do have similar company size. They're both gaming industries and they're evolving. Because of the 2020 pandemic, they have boomed within their industry. However, to invest in, we would want to choose Electronic Arts. With Activision under investigation with the DFEH, World of Warcraft is also losing subscribers by the thousands. Call of Duty is decreasing in popularity, while Apex Legends, a rival game of Call of Duty, is increasing in popularity, and the new Battlefield game coming out soon, that all makes EA more attractive into wanting to invest. It's clear that EA is gaining a lot of profit, will be gaining a lot of profit within the next few months, and the stock prices are sure to rise. And that concludes our presentation. Do you have any questions?
Thank you.